podcast show. How are you? And how is the mortgage market doing? As we have seen, the last BOC has flashed the 25 point BPS points, the rate cut. What does that impact on the buyers?
I'm doing well. Thanks for asking. Yeah, lots has happened. I think that with this rate cut, we've been expecting to see people, heading and rushing to the market and starting to buy. I don't think that's exactly happened. And I think we've also been expecting interest rates to come down. I think that we still need to understand the difference between the overnight rates, which is what we talk about when we discuss prime, and the actual fixed rates. The overnight borrowing rate impacts the prime rate, which impacts variable rates, and the fixed rates are determined by bond yields. So if we see a 25 basis points reduction in that's going to impact the variable rate. On the fixed rate side of things, we've actually seen rates go up a little bit since this 25 basis point reduction. So case in point, like this week, we've been seeing on, let's say, a 5-year fixed mortgage with a specific lender for a specific product, we were getting 15, 20 point discounts off of their posted rates last week. This week, it's more like 10 or 15, right? So we're getting less of discounts. So the rates aren't necessarily going to go down. In some cases, they've gone up, right?
Yeah. And one more question comes up over here, like how many rate cuts are we expecting this year from the BOC?
That's a good question. I think if you listen to the big 6 banks and their prognosticators, they're anticipating anywhere between another 3/4 to 1% reduction from where we are now within the next
That
12 months.
that's
Now,
huge.
how accurate or how realistic that is, I mean, I don't know. It remains to be seen, right?
So on counter, if you take the counterpart US, the Fed haven't started yet a rate cut. Today also the CPI data came in. The data was showing that the core CPI is 3.3. The with
Mhm.
food and energy that is up. That went up like 0.1% or 0.2%, 0.2% from the
Yeah,
last month. But
yeah.
the CPI data that came in, that came 0.1% below the last month. So overall impact is like what the Fed is expected. Fed is expecting more proof. So if they do not does a rate cut, think about like this way: if US doesn't does a rate cut, and Canada does another couple of rate cuts, what impact you think it gonna come up for the Canadians?
Well, I think that by cutting our rates, if nobody else is cutting our rates, it's going to impact our dollar at the end
Yeah,
of the day,
that
right?
that's
And I
that's
think
definitely.
that's where you're going with this.
Yeah,
Absolutely. Now,
yeah,
one thing I'd like to just mention about these predictions, a lot of times these forecasts, they're done based off of data, and those data
yeah,
points, they change daily, right? Like you just
definitely,
mentioned,
definitely.
yeah, you just mentioned the CPI. Now, for the last few days, people have been predicting that they're going to be 3.1, 3.3. They're not entirely sure. Now, here's the thing. The government, they don't really tell people this. Politicians don't really tell people this, but they themselves understand that these predictions and these things that people are doing, they're only as good as the day's data, right?
Yeah,
They understand that it's not necessarily going to happen, but there's a public appearance that they have to make, because if people really think about it and they realize that they don't really control this, they can only increase or decrease based on what's happening in the economy, but they don't have any control over what's going on in the economy, right? We're
definitely.
talking about, like, they're manipulating
Yeah,
the
true, very true.
the CPI itself, right? So if we look at this, the CPI numbers, if they're lower, but they've changed the bundle of goods that they're looking at.
Yeah, that's
So
definitely they did it. Yeah, I
so
know.
if we have a consistency in those numbers, so if we let's say we look at a basket of goods, the same basket of goods, from 12 to 18 months ago. What's happened? We've seen that bundle of goods become more expensive. There's a few exercises, a few videos people have done about this. I don't have the exact details top of mind right now, but I was blown away. If you look at the cost of orange juice, just for example, in the last 2 years has gone up like triple digit percentage points.
Triple digit percentage. Even there are lots of, especially the grocery department. If you go, there are prices, food and grocery. The prices have tripled, prices have doubled, and
Absolutely.
what they had did, like, they used to, when the code, they used to count the core CPI. They used to take the bundle or the basket. But now what they did, they changed their formula. As a change in the formula, many of the things are left out, and it's more of like a tricky thing. Yeah,
Well,
the government.
they're doing that to make it look like,
Yeah, yeah.
right? Otherwise, if they kept the same bundle consistently, they would see that the actual rate of prices isn't going down,
No, no, it's not going down.
right?
It's
And then
stagnant.
that would trigger higher rates. So they're kind of playing this game, and it's a dangerous game. And this is why. Like I had a conversation yesterday with a client who seems to think that in like this is the thing, it's on us to educate ourselves, right? These people seem to think that whatever we saw in 2021, 2020, those are normal rates. Those are not normal rates. If
No,
we're expecting to get back to 2%, that's very dangerous, right? I
yeah,
don't think we're
definitely.
going to see that again, right?
Yeah, very, very hard to get all those numbers that you have seen back in 2020, 2019. Those will not repeat anymore. Those are gone. Those are
I mean,
past days.
if they do repeat, we're gonna have some major pain, because the reason we have low rates like that is because the economy is so bad that they need to stimulate and they need to relieve, right?
And
Um,
one more thing I'm gonna touch base before we start or we jump into our today's session. There are one more thing I when I'm going through all the banks and the central bank, especially the big fives. The big fives, they,
excuse me.
yeah, no, no worries. Uh, so what the big fives have done, they have they have their branches all over. They expanded their branches all over from East Coast to West Coast. Okay, and now the thing I'm saying, like, especially I'm talking about all the banks. I'm not particulating any. What now they're
Yeah,
doing, they are just cutting out of the branches. Like, I have heard about two of my friends. They are working, one in Scotiabank, another in BMO, and the third guy is working in CIBC. CIBC, the big branch on the commercial drive, the CIBC.
yeah,
They closed that. That's
yeah,
gone.
yeah.
And another, my friend used to work over there, laid off. They haven't transferred anywhere. Another friend of mine who works in BMO back in the West Broadway, it's gone.
Wow,
They didn't transfer, they just laid off. Another
they're
friend
just
is
like, yeah,
working on
yeah.
English-based Scotia Bank. They already told that the bank will coming to close. The branch is closing up in the month of September. So you might get it or you might be gone. So
Wow.
why is this happening when everything is good? The things are looking so good in the economy. Everything is very smooth. We are growing, but why then the banks are doing like this kind of things, like cutting up their branches? What do you think about it?
Well, I think that when it comes to banks in general, um, they're all about their bottom line, right?
Yeah,
As individuals, as consumers, we feel like the banks, we're their customers, they do what's right for us. They're always looking at the bottom line and their shareholders, right? If you're a shareholder of the bank, that's what they're looking at. So they're looking at this from a um, like bottom line percentage. They're like, we can get away with having people wait 2.5 hours online waiting to talk to somebody. Nobody's complaining about it. So
yeah,
we have the ability to go and lay off and close this branch because we can just get it overseas, and we have people overseas handling the banking,
yeah,
and the cost and revenue, um, or sorry, the cost and wages is going to go way down. Our revenues are going to go up. Those are the decisions that they make. As far as more generally, we're it's not just the financial sector that's seeing this, it's all of the sectors.
yeah, okay,
And I think this has it's such It's not just one answer, right? You look at the government. The government is coming in, and their solution to everything is to try and regulate it and tax it. Now,
Actually, yeah,
if you look at it, the private sector is not growing. The only sector that's growing is the public sector. So anytime you have a government job come in, what happens? You actually need tax money to pay for that job, which
yeah,
comes from the private sector, right?
yeah,
So if they're a service-based company right now, you're exiting Canada because it's just too much to run your business here, right? And this is a fine line. I mean, we can talk about this. I'm not saying that we should be giving tax breaks to companies. That's not what I'm saying at all. What I'm saying, though, is if you're taxing people too much to this level, it's getting to a point where it's actually cheaper for them to do less work and be less productive. It's kind of the same thing. I don't know if you saw this. Jagmeet Singh came on Twitter yesterday, I think it was, and he was outside of Superstore, and he was comparing President's Choices potatoes being $9 a sack, and some other brand, and saying that we need to go in and we need to instill price controls with these companies. Now, if you're a manufacturer
yeah.
and you're going to be told that you need to operate at a loss, what are you going to do?
I'm
Are you
gonna,
going to
I'm
produce,
gonna
right?
shut down my unit in Canada and then move to any other country
Well,
where I'll
you're
break
going
it.
to do
Yeah,
that, but if the government's forcing you, what are you going to do, right?
shut down. I'm not gonna work.
So, I mean, the thing I would look at is why are we sending all of this money that we have out to other countries to help them with some issues that, again, I don't want to get political here, but
Yeah,
if we can't even provide homes for our own people in our own country, why are we sending money out? And why is, like, we're talking about Jagmeet Singh in particular here, he's worried about $9 potatoes, but why is he prolonging and supporting this government to secure his pension, right?
yeah,
Anytime he gets asked about that question, he dodges it. So, and on that note, when it comes to government, when your government becomes so big that it's becoming such a heavy um, load for people to support, you have to increase taxes and figure out ways to make people, pay people to work in government. I mean, if you look at history, that's kind of the start of a fall of an empire, going all the way back to the Roman Empire, right?
yeah.
So
Okay,
I don't
we
want to,
will. Yeah, we
yeah,
will not jump into politics anymore. Let's start
yeah.
our today's show. And today we will discuss about the most searched mortgage questions in Google. So there are lots of questions we when we are looking or when we are doing research, we found out there are lots of questions. We won't be able to discuss everything for today, but I have selected out of like from the 50 to 60 question, I've selected three questions, and let's discuss these three questions.
Sounds
So
good.
so let's start. The first question comes: How do we know which home mortgage option is right for us?
So I think that it's such a personal question. There's so many things that need to be clarified before answering this question.
Okay.
Um, I think that if you're looking at trying to figure out what the best mortgage is for you, um, you need to ask yourself, okay, what is the purpose of this property? Am I looking to live in this for the next 20 years? Am I looking to um, move anywhere? Is there going to be anything that I might need in a couple years? And where I'm going with this is a lot of times we're focused on two things. We're focused on the price. We're looking at the rate and the payment.
Yeah.
Now, those are two important factors, but that's what our banks they want us to think about, right? They want us to think about price as opposed to cost. Now, the
Okay.
difference between price and cost, price is what it is right now. It's going to cost me, 5%, and my payment's going to be $2,500 a month, right? Cost is going to be down the line. What if I need
Okay.
to refinance? What if I'm moving? What if I get divorced? There's numerous reasons where your costs could go up, right? So
Yeah.
I think depending on your individual goals, depending on where you are in your life, that's what someone like myself does, is we come in and we assess what could go wrong according to your plan,
Hmm.
what might not happen, and help you figure out how to mitigate this and make it less costly down the line, right?
Okay.
So I think also this question is different for people that live in Vancouver and Ontario, like BC and Ontario, than it is in other provinces. And the big reason for that is because the values of homes are a lot higher typically in those areas. And in 2016, the government came in and they made all of these rule changes, which impacts um, the types of mortgages behind the scenes and what different
Okay.
banks can offer and what other banks cannot offer. So, particularly if you're in these two provinces, it's important, even more important for you to understand and have these deeper conversations and ask deeper questions.
Okay. Okay. Got it. So we're gonna go to our second question. So explain how to, or I'm gonna say how uh, we can qualify, or how what is the best way to qualify for a home loan or a mortgage.
So, like again, it's a qualifying and figuring out
So
where
for
you
example, I'll
stand.
I'll give you an example that would be things will
Yep.
make easy. For example, I'm thinking like I have an income of $100,000 and I'm thinking of buying a place that cost around uh, but I'm just take it as an example, 600,000 to $700,000. So, in my point of view, what if I'm thinking that should I qualify or should I not? How will I understand that I'm gonna qualify or not? What are the things I'll be looking for?
Well, I think there's a lot of things that you find online. There's like 60-second approvals, 2-minute approvals. I think it's important to get help answering this question, and there's two big reasons why.
Like
Okay, first,
I'm gonna just interrupt a little bit and then I'm gonna to get back to you. Like
yeah,
definitely we will go for help, but before going for help, if we can do our homework so that when I'm going for help, the person who is helping doesn't need to ask too many things. All everything is ready.
yeah, absolutely,
So
absolutely.
yeah,
Okay, so this is where I was going with this. Okay, so it's important to understand your income
yeah,
and the type of loan that you're looking for. If you've
okay,
got 20% down or more, some banks can actually make some inside decisions because they don't have to go through the insurance. So anything under 20% down requires mortgage insurance in Canada. Those guidelines are black and white. If you
okay,
got 20% down or more, there's a bit of a gray area where, depending on how strong your file is, how good your credit is, how much maybe help you have, maybe there's somebody in your family that's not going to be on the mortgage, that's going to be living there. Maybe you're due for an inheritance. People can look at that and take that into account if you've got 20% down or not. Okay. So first, it's important for you to identify how much down you have. Okay.
okay,
Next, it's important for you to figure out exactly how much income that you have. You're in your situation, $100,000. If you make $100,000, but how much are you declaring to CRA? If you're a salaried employee versus a consultant, if there's a difference.
yeah,
So it's when you're looking at AAA bank financing, it's whatever they can only take whatever you're declaring to Revenue Canada. So if your
okay,
income line 150 says $150,000, your job letter says $150,000, your T4 says $150,000, then okay, we can use that. But if you have some bonuses, overtime, things like that that's not regular, we need to look at a 2-year history.
okay, got
So
it.
you need to understand what type of work you're in, right?
Yeah,
And understand what those guidelines are. And basically after that, we need to take into account property taxes, condo fees if applicable on the property, and heating costs. Now, typically, you want to be very conservative in your numbers. So if you think that condo fees are no more than $300, I would say take 350
okay,
and use that as part of your calculation. And if you think that property taxes aren't going to be more than 2,200, I would say put 2,400 or 2,500. Don't use the homeowner grant. Use $100 for heat. If your property's 1,000 square foot or less, $100 will probably be more than enough. And then you're basically just using your all of the expenses and you're dividing it by your gross income, and that number cannot go past 39%. And then there's another number, that's your gross debt service ratio. So your housing costs, so your property taxes, condo fees if applicable, monthly mortgage payment, divide that by your gross income. If that is less than 39%, and if your credit score is over 680, then you're okay. Then there's another formula where you add everything that I just mentioned plus your other debts. So if you have a car loan, student loan, anything like that, you add that, that cannot exceed 44%. So again, you need to be clear with your numbers, and you can use the online calculators, and it'll ask you property taxes. You can import all that information, but if you're not inputting the right information, you're not going to get the right information out. Right. So those are the things that you have to look at. You have to look at income, and you have to look at the expenses on the properties that you're looking at. Now the properties are going to range, so you have to do an estimate, right? So that's what I would say is that's the best way to figure that out. And then you want to see what your numbers are. If you're really close, then you can take the next step. And the next step would be to get this stuff verified with a professional and make sure, right?
Okay. Yeah, that's good enough. That's fair
So
enough.
something like this, sorry to cut you off there, something like this could take you probably, if you have all the information, probably take you no more than 20 minutes to work out yourself, right?
Got it. Okay, so we're gonna jump to our third question.
Sure.
So provide tips for buying condo units. Like how certain mortgage lenders will not provide mortgages to purchase condos unless they meet certain criteria.
So
Why there are some condos, why they would not, the lenders will not provide mortgage.
so I think the biggest thing to take into consideration here is that doesn't matter who the bank is, doesn't matter if you've been there for 30 years. The way they conduct business is based off of formulas, and like someone's not just going to sit in front of you and say, okay, I approve you anymore, right? So they don't really know you from a hole in the wall. They look at your income, they look at your credit, and they might really think, okay, the probability of this person defaulting is probably less, so we're going to give them a mortgage.
Okay.
But they're taking the property as security. So if you can't make mortgage payments, they take that property, right? But they don't
Yeah.
want to keep that property. They want to sell that property. So if there's a condo building, for example, and there's issues with it, their biggest concern is going to be marketability. Can we sell this property? Is it difficult? So if you have a property where you want to look at a few things. You want to look at their contingency funds. Is it well managed? Is the strata well managed? I'll give you an example.
Okay.
Not too long ago, we had a client looking at a property in West Vancouver, a 3-bedroom townhouse style condo. So in the minutes, there are two things that are concerning. The biggest thing that's concerning is there's some stuff that needs to be repaired in the electrical. And the inspector who did the inspection said it was a fire hazard. So a bank looking at this, they're going to be like, okay, we need this fixed before we can advance. Otherwise, what if this thing blows up? Then we lose money, right?
Yeah.
You're not, and then if we go, like, let's say if I'm a bank and I don't do my due diligence, even though I have insurance, if I go to my insurance company and I show them this file, and they're going to see that and they're going to say, hold on, there's a fire hazard here. You still lent the money and then it blew up. Why? We're not paying this. Then the bank's on the hook, right?
Yeah.
So in certain situations, depending on what it is, they will want to make sure that the city has approved it. And basically, they're just looking to cover their rear ends, right? So that's the reason why certain lenders will not lend on certain properties. There are certain lenders, though, that put less of an emphasis on looking at the minutes and the stratiform Bs and stuff, right? So if there's pending litigation or anything like that, if somebody's going to go and sue the strata, if your buyer is going to need a special assessment of $30,000 that you know that they don't have, those are all things that a lender is going to consider. Because what if you have a special something that's going to come up and it's going to cost you 30,000, but you're putting all of your money in for the down payment, right? The
Yeah.
bank's going to need to consider that as well. So those are a few reasons why um, it's a bit more difficult to get a strata property, and it all has to do with the bank making sure that the security that they're taking meets their guidelines, because they don't want to hold it. Their whole
Yeah.
goal is to just lend money. They don't want to become property managers, right?
Yeah. Definitely got it. Understood. Wow. And today's last question would be like when a home owner should take advantage of an opportunity of refinance for their home loan. Is there any particular time when they can utilize or they can use their home ownership as a refinance as a mode of advantage?
Well, I think that anybody who's coming up for renewal on their mortgage should take it as an opportunity to review their entire financial picture and
Okay.
see if it's going to be an advantage to refinance. The biggest reason for that is it's never going to be cheaper for you to refinance at a point when you're essentially your contract is up, right? Because there's no
Yeah.
penalties, nothing like that. So you can look at it at that point. As far as a point where a homeowner it'll be advantageous, my opinion is you should be doing semi-annual or at the very least annual reviews with your mortgage provider to determine if your mortgage is still working for you. A lot of times, let's say for example yourself, right now you're single, um, you maybe buy property for yourself, and then in 6 months you might find someone and you get married.
Okay.
And then in another year and a half, maybe you have a child, right? So your life is different when you got the mortgage as a bachelor than it is in 2 or 3 years. But if you haven't talked about your mortgage, or if you haven't really looked at any of these life changes that you've made, maybe this mortgage is not working for you anymore, right? Maybe it's not optimized for you and your lifestyle.
I
So
have a question. I'm gonna interrupt. Sorry. What
yeah,
do you mean by the mortgage is not working for that person?
well, for example, um, I've got clients right now
Yeah.
that took a mortgage with a 15-year amortization.
Okay.
Couple, they wanted to pay their mortgage off aggressively, and they never wanted to have children or anything like that. So they're like, it's just us, we're going to be fine. Two and a
Okay.
half years into the mortgage, they got pregnant. So they're like, oh, and then like, okay, we're going to have a baby, right? So
Okay.
now in our semi-annual review with them, after they found out they were pregnant, they were like, 3 months from due date, and wife's going on mat leave, then we're thinking about this and we're like, listen, is there a way that we can, help with your cash flow? Because cash flow is becoming a concern for them, right? So looking at it from that perspective, they didn't even consider this. But one of the things that we could do for them, because of the way we structured the mortgage originally,
Yeah.
is we could re-amortize that mortgage back to 30 years to keep their minimum payments in line with whatever is comfortable for now, while they get acclimatized and accustomed to having this new person in their family and lower income. And then they can increase their payments again if they want to get back to that schedule, right? So little things like that we can look at. Also, sometimes, the way we register a mortgage, we can possibly take advantage of taking some equity out and helping pay for some renovations or something like that. Um, there's tons of things off the top of my head. It's difficult to think of situations, but being in touch constantly, it's like your investments, right?
Yeah.
Um, if you're only looking at your investments every 5 years, people don't do that. Even your car loan, even your like if you're going to Costco, right? You're a lot of people go to Costco because they're like, you know what? I know that I can return anything to Costco at any point in time, so I'm willing to spend $5 extra, $2 extra, right? we take more thought in that than we're looking at our finances on our mortgage. And our mortgage is likely our biggest obligation in our lifetime, right?
Yeah, got it. Understood. Okay, yeah, that covers everything for today. And thanks, Mr. Alim, for your time. And hopefully our viewers enjoyed our today's show. Hopefully these questions, these answers will be helpful in their way to mortgage or any kind of mortgage maintenance they're gonna do in their coming up months or coming up days. So that's everything for today. We want all our viewers to have a successful financial life. Hopefully, you guys like our today's podcast. Please keep watching our podcast and keep sharing with your friends and family. We will try to bring in more financial topic that can help you save money from your mortgages or from any kind of borrowing and keep you one step ahead from your lenders. Have a wonderful rest of your week. See you again in our next episode. Thank you.